Okay, Chapter 18, Lesson 2, which is long-term debt financing. We just talked about short-term, now we're talking about long-term. Identify the components of a loan application and journalize transactions related to long-term financing. So applying for a business loan, as a business expands, it must purchase more equipment and other plant assets. The assets or other financial resources available to a business are called capital. We talked about that in a previous chapter. Purchases of plant assets used in the operation of a business are called capital expenditures. Capital expenditures buy assets, and assets are used for a long period of time. They're not disposable. We talked about how capital assets, they're used for a long time, so their value decreases over time. That's how we talked about it in a previous chapter. So they usually cost a lot of money. Corporations often require large amounts of capital to finance capital expenditures. A business can obtain this capital from both internal and external sources. The portion of net income not paid as a dividend is an internal source of capital, but internal capital may not be adequate. Therefore, a corporation must acquire additional capital from external sources. These might include borrowing money or selling stock. So banks are usually a very convenient source for external capital. You need to obtain a loan, and with a loan, the bank takes a risk that you as a borrower will not repay it. It takes a risk that the company is going to go under and not be able to pay back the banks. So banks often require a business to pledge certain assets to secure a loan. Assets pledged to a creditor guarantee repayment of a loan, and it's called collateral. If the borrower is unable to repay the loan, the creditor can take the collateral and sell it to pay off the debt. When you apply for a business loan, there's lots of questions that get asked of you. Each section addresses common questions asked by the bank loan officers. So, what are the funds going to be used for? What experience do the owners of the business have? Who makes the decisions? Do they anticipate any problems? What's the market demand for the product or service? What's the competition look like in the business? What are the financial projections? Have you planned for the future? When is this project you're working on going to be profitable? What is the business plan? Collateral. What are the assets that you're going to offer as collateral? How much are they worth? Will it be easy to resell them? Also, capital profile. What is the business risking in the project? Does the business have an adequate stake in the project to ensure management's motivated to succeed? So, signing a long-term note payable. A note payable signed as evidence of the debt when receiving a bank loan. Our example is April 1st. Signed a 5-year 8% note for $120,000, and there is a receipt. So our cash account is affected, as is our long-term notes payable account. We fill in our cash receipts journal, first of all with the account title and the receipt number. The amount borrowed goes into credit in the general credit column, and then cash received from the bank goes into the cash debit column. The banks require the company to make monthly payments on the notes. So after Sun Treasures signs the note, the bank deposits the principal amount of the note in Sun Treasures' checking account. The note agreement requires that it make a payment on the first of every month. Upon signing the note, the bank provided Sun Treasures with a schedule of monthly payments. So we have the balance is how much they borrowed, and then each month what is paid. So the first month they're paying $800 in interest and $1,633.17 as principal. So they pay this total amount together and then subtract it from the beginning balance. So there's your ending balance. This ending balance goes into the beginning of the next month. Interest, principal, subtract it out. That goes here, etc. for 5 years. Okay? So the monthly payment is always going to be the same amount, but if you see, the interest and the principal changes. It becomes less and less interest, more and more principal, until you would get to the end of the 5 years and your interest is very small and your principal is very big. Let's see. So if you look, the interest and the principal portions of the August payment are highlighted in the payment schedule. The monthly payment will enable Sun Treasures to fully repay the loan by the end of 5 years, which is 60 months. So our first example, August 1st, paid cash for a monthly loan payment, $1,666.05. Interest, $767.12 was the interest. So the principal, the interest, which is a total of $2,433.17 with a check number. So it's affecting our long-term notes payable. We have to pay that down. Interest expense. And then our cash goes down. In our cash payments journal, we write the dates, the long-term notes payable account, and the interest expense account. The check number is there also. So the principal amount, the interest amount, which you add together for the cash paid. Large loans can be difficult to obtain from a single bank. An alternative to borrowing money from a bank is to borrow money from individual investors. A long-term promise to pay a specified amount on a specified date and to pay interest as stated at stated intervals is called a bond. Like notes payable, bonds are written promises to pay. Bonds generally have extended terms such as 5, 10, or 20 years. Also, bonds payable tend to be issued for larger amounts than notes payable. All bonds representing the total amount of a loan are called a bond issue. A corporation usually sells an entire bond issue to a securities dealer who then sells individual bonds to individual investors. The process of selling bonds is commonly referred to as issuing bonds. So we discussed right here. Each bond has a face value, an interest rate, and a due date. The face value is the amount to be repaid at the end of the bond term. The interest rate used to calculate periodic interest payments on a bond is called the stated interest rate. The face value is multiplied by the stated interest rate to calculate periodic interest payments to investors. Many bonds pay interest semi-annually. Okay, issuing bonds. So here's our first example. On July 1st, issued 20-year, 6.5%, $5,000 bonds at $180,000 with a receipt. So we have our here we are. There's our first example. Our cash is going to increase and our bonds payable is going to increase. So let's fill out our cash receipts journal. So our date, bonds payable with our receipt number, credit is affected, and our cash debit received. So we borrowed $180,000 and we received $180,000 in cash. Now let's see how that all works out. So paying interest on bonds. Corporations issue one check for the amount of interest to be paid, usually to an agent such as a bank. The agent then handles the details of sending interest checks to individual bond holders. Sun Treasures bonds require that interest be paid semi-annually on June 30th and December 31st. Interest on the bond is calculated as the face value multiplied by the stated interest rate. So we have the face value of $180,000 and the stated interest rate of 6.5%. So if we do some times 0.065 gives us 11,700, but the fraction is the time of the year. It's a half a year, so you can multiply by 180, divide by 360, which is 5850, or start over, times 0.065, divide that by 2, and you get the same number. So our interest expense is affected, as is our cash. So to fill out our cash payments journal, we have account title of interest expense, the check number that was issued, the interest amount, and the cash credit. And that's it. So what is the purpose of a business plan submitted with a loan application? It convinces the bank that you know what you're doing, that you have a plan, that you know where the money is going, what it's going to purchase, when do you expect to become profitable, etc. What can happen to collateral if a borrower is unable to repay a bank loan? The bank takes it and they sell it in hopes of repaying the debt that you owe them. Identify the primary sections of a business plan. This is on page 559. So we went over questions of interest to bank officers. There's also a summary of the business plan, which is the answers to the bank officers. So the bank asks all of these questions, and we went over each one of these questions. The answer to those questions is, in essence, the company's business plan. Investor A sells a bond to investor B just days before the interest payment is made. Which investor receives the interest payment? Investor B, because they own the bond. What are two common differences between notes payable and bonds? Bonds generally have extended terms, such as 5, 10, or 20 years. Also, bonds payable tend to be issued for larger amounts than notes payable. And that's it.